over 100,000 immigrants have left Canada in the last 12 months. Many more are expected to leave in 2025 and 2026. But this is not the first time it's happening and won't be the last. Because that's how recessions work. When the times are good, economy is booming, market is going up, real estate is really going strong, and there are plenty of jobs in the market. And then something happens and a collapse is triggered. People lose jobs, businesses lose money. Economy starts to sink and we go into a recession. Immigrants get tired of the struggle and leave. Sounds familiar, right? I am not talking about today. Here's an article in Globe and Mail published in May 13, 2012. And this talks extensively about the reverse immigration that was happening at the time. Now remember, 2012 was still a dark time in the US. It was 4 years after the recession had hit, the subprime crisis had hit, and the markets, especially the corporate world, had not yet recovered from the aftermath of 2008. It talks about a person called Praveen Rao. After 11 years of Canada, he owned a house, he had a snazzy car, a motorbike, and then he decided to leave for India because there were better opportunities for him in India. This article goes on to talk about 100,000 that are said to have come back last year, and the number is growing. So reverse immigration is not a new phenomena, and it happened in the last recession as well. Now this 100,000 number was in 2012, but even in 2010 there were about 30,000 immigrants who left Canada. If you go further down in the article, just before the subprime crisis, it talks about the immigration that had peaked in 2008, about 850,000 people who left India for Canada, which is very similar to what has happened in the last 3 years. So this article is eerily very similar to what's happening right now. And the number one cause of that reverse immigration was also unemployment. If you look at the unemployment data from 2007 to 2019, you would see that after the subprime crisis, even though the Canadian real estate was not hit, that's why a lot of people say that Canada was not really impacted, because a lot of that impact is usually talked about in real estate sense. But if you look at the unemployment, if you look at people not having jobs, it was pretty high. It was as high as 8.3% in 2009, and it remained over 7% till 2013. And those 6 years between 2010 and 2016, there were almost 400,000 people who left Canada. That's almost 80,000 people per year. And that makes sense, because the overall doom and gloom that you see right now, it was there back then as well. BlackBerry had fired 40% of their workforce between 2011 and 2013. GM, Chrysler, Ford, because they were the most hit during the 2008 recession, they cut 10,000 plus jobs in 2008 and 2009. Overall unemployment peaked at 8.3. We saw that in the previous chart as well. Small business insolvencies are up over 30%, this time around, but it was pretty high at that time as well. Upwards of 10% increase from 2008 to 2010. Household debt rose from $916 billion in 2007, before the subprime crisis, to $1.6 trillion in 2013. And these are all Canadian numbers. Debt to income ratio, so the overall debt that you have, let's say you have $100,000 of income, there was $160,000 of debt in the economy. So the debt to income ratio was 160%. Right now, this number is 170%. And mortgage debt accounted for 70% of household debt. Right now, it's 74%. And when all this doom and gloom is happening, there is a lot of negativity, and a lot of people without jobs are unable to sustain their lifestyle and hence leave, which is where 400,000 people left Canada between those 6 years. Now, of course, when doom and gloom is being talked about in an economy, there were predictions being made about the housing market as well. Housing prices due to fall, says think tank. I don't know who this think tank is, but this was predicted back in August 31st, 2010. There were several reports, even until 2012, that was saying that Canada housing will remain flat for the next 2 years. If you go back to 2011 and 2012 and look at the YouTube, like the search on YouTube, I just said Canada housing bubble 2012. If you search Canada housing unaffordability 2012, there was so much doom and gloom. It says 2012, outlook, Canada housing bubble balloon, Canada housing bubble 2012, end of Canadian housing bubble. It's filled with all the negative news that we see right now. But I, for one, was very curious what actually happened to real estate. If you look at the last 10 years, from 2007 to 2017, not last 10 years, but from 2007 to 2017, the reason why I'm looking at this period is because it actually came off of a recession. And I'm not saying that it'll be exactly the same this time, because the reasons for recession is very different. It cannot be exact same. However, there are certain similarities that we can draw. There are certain learnings that we can draw. And if you look at the real estate market from 2007 to 2017, when people were saying that there'll be doom and gloom after 2008, it increased. If you look at the year-on-year growth of prices, this is GTA prices, by the way. This is taken from Treb, which is the most reliable data that you can get right now. It increased by about 4% in 2009. This was 1 year after the subprime crisis. 9% in 2010, 8% in 2011, 7% in 2012 when that article came out. Again, 5% and 8% in the subsequent 2 years when that article and many other articles at the time said that the real estate market will not, go up. 2015, 16, 17 was crazy, 10, 17, 13%. And if you look at any 5-year intervals, real estate has always grown over 5% in Canada. And if you look at the 10-year intervals, it has grown 8% from 2017, from before the crisis that hit Canada. Right now, this particular number is well over $1 million in GTA. So I understand the doom and gloom. I understand when we are in recession, when people are losing jobs, when inflation is very high, when interest rates are doing all sorts of things, there is a lot of negativity in the economy, and that's okay. However, it never lasts. In fact, if you look at the last 50 years of data in real estate, and you can look at it from a stock market point of view, you can look at any data, that's available to you. If you look at the last 50 years, let's say in real estate, the 10-year year-on-year return has always been very high. Let's talk about 1975 to 1985. It's 6.6% return year-on-year across those 10 years. If you look at the next 10 years, it's again 6.4%. If you look at the next 10 years, it's again 5.2%. If you look at the next 10 years, 2005 to 2015, which also had a major recession, it's again 6%. And if you look at the last 10 years, it's still 7% increase year on year. Let's assume that you bought at the peak in 1989. Now, it's very funny that we are calling this a peak. It was barely $150,000 or less than $200,000 of detached home that you can buy in the GTA area. But let's assume that you bought at this peak where there was a lot of doom and gloom. This was also the time when we were hit with the largest recession that Canada had seen. And even at that time, if you had bought real estate at that time, right now, the real estate would have grown 35 years later at 4% year-on-year return. And if you had bought before that peak came back in, let's say 1985, you would have enjoyed a 6% year-on-year return. All this to say that yes, recessions can happen. Yes, short term, there could be variability in the market, whether you look at the stock market or any asset class, including real estate. But long term, when you look at across decades, there is less variability and there will be growth that you can see in any asset class. I'm not the only person who is talking about this. Let's see what Warren Buffett has to say about recessions.
Well, I don't think there's a particular risk in the economy over time. We will have recessions from time to time. And we had a real doozy in the fall of 2008 and early 2009. And that has had more consequences than other recessions have had post-World War II. But the American economy is a wonderful machine. It really works. It's worked since 1776, and it'll continue to work. But we will continue to have ups and downs.
The doom and gloom is real, and it happens in every economic downturn. But hand to heart, do we really think this is it? Is our life over? Because grocery is double of what it was pre-pandemic? Because the government is not building enough homes? Is our life over because Justin Trudeau's government is charging us too much carbon tax? Does it really make sense to say that because temporary workers are leaving Canada, everything will crash and burn? I don't think so. How about the fact that we are in the middle of an amazing AI revolution? How about the fact that this video that usually takes me 2 days to make, I can now make in 6 hours thanks to ChatGPT and different AI tools? My wife Simran is an app developer and knows that AI will take away her job eventually. She has 2 options. One is staying in denial and cribbing about the industry and AI and how it's taking away jobs. Or learn different tools that can make her life simpler, making the same code in 1/10 the time. Efficiency brings profits, and there will always be space for profits in any organization. I think she needs to focus on that. It's never been easier to start a business, create content, have a following. So we can either dwell on the doom and gloom that's there in the economy right now and suffer, or accept the fact that this time shall pass. You don't have to take my word for it. Warren Buffett has lived through more recessions than any of us, and I choose to listen to him over any noise that media throws at me. I call this the 1% thinking. And if you are like me and want to think differently, start a side hustle in 2025 and scale it into a full-fledged business, you can join my weekly newsletter. It's called the Grow Nation newsletter, and I will be sharing really good nuggets every single Sunday, 8 a.m. right into your mailbox. The link to joining that is in the description below. Now, knowing what I know today, how am I preparing myself for 2025? And I am going back to basics. I just upgraded to my forever home, and because I was buying a 1 million plus home, I was able to get a 1.4 million home for $1.2 million, and I am never likely to sell this home. And that's the reason why it does not matter what price I buy it at. I will make this mortgage free, I will retire in this home, and probably downsize or keep living in this home forever and pass it on to my kids. And like I say always, the number one reason why you buy a primary home is because you want to retire, mortgage and rent free, and not because you want to make money off your primary home. That's plain stupid. Talking about making money, I'll have a very different approach to the stock market. I think we are overvalued on the stock market. I actually made an entire video on this. I will be making another video on Warren Buffett's approach to this particular, coming 2 years. I'll talk about that in my next video. So do subscribe to the channel if you have not done that. But my strategy for 2025 will be, I'll be investing 50% of all my investment budget into stocks and ETFs, and I'll be keeping the rest 50% of my stock budget. So it's still the stock budget that I have, but I'll be keeping it in high interest savings account like cash, which will give me a 4 to 5% year-on-year return. It's just a high interest savings account, but in an ETF form. And the reason why I do that is because if the stock market actually crashes, I'll have cash available to double down on some of my favorite stocks. I'll talk about that in my next 2 videos. Do make sure that you're subscribing to it. The third one, real estate. I'm into real estate, and I'll be buying cash flow properties only. That's the reason why I said going back to basics. There are so many people talking about really good investments. They're talking about appreciation opportunities. They're talking about flips. I'm not doing any of that. The only properties that I buy in 2025 will be cash flowing. It gives me $500 to $1,000 a month. If that doesn't happen, I'm not buying it. And the reason is because if the market crashes in the short run, I don't have to worry about negative cash flow. I can just keep collecting the rent, keep getting the positive cash flow, keep the property for 5 to 10, 15 years, and then take out the equity if I need it. Here's something that I've learned in the last 4 years from the richest. People buy real estate not to make money, but to preserve wealth, which is exactly why the smartest investors invest only in cash flowing assets and don't rely on appreciation. And the fourth thing is not staying in denial. I'm in the mortgage business, I'm in the real estate business, and this business will also be eventually hit by AI. And I want to look at my entire workflow in my mortgage business and my media agency and learn and invest in different tools that can improve my business and help me serve more people. I'm just not the kind of person who will give up just because the economy is difficult. And because I'm such a big fan of Warren Buffett, I know we'll get over this. That's all I have for today. मिलते हैं अगली वीडियो में, तब तक के लिए बाय बाय।